Welcome to another special edition of the 3 and 10 podcast. These discussions with investment or industry leaders are set apart from our regular Friday podcasts. They are both longer and more in depth. We hope you will enjoy, learn, and profit from this special edition of the 3 and 10 podcast. Well, hello. I'd like to welcome everybody to another special edition of the 3 and 10 podcast. My guest today is the acclaimed Torsten Slok. He is partner and chief economist at Apollo. Torsten has over 20 years of experience in economics and markets. And I met Torsten back in the very early days of the global financial crisis in 2008, when he helped me tremendously back when I was a portfolio manager at Tudor Investments. And we know Torsten for his Daily Spark, which is one of the more famous daily missives that go out around Wall Street. But I think even more importantly for his candor and for his out of consensus views and willing to speak the truth about what's going on in the environment right now. So welcome, Torsten. It's always great to be with you, and looking forward to our conversation.
Thanks so much, Scott. I'm very excited, and look very much forward to hear your views also going into 2026.
Well, of course, and I think we should start our fireside chat here with a question on the Fed, because we had the meeting last week, and of course they cut by 25 basis points, but there were some other nuances to that meeting. And my first question to you is, do you believe the Fed should have actually cut policy rates last week at the December 10th meeting?
So it was a very difficult decision for the FOMC members, as also reflected in some FOMC members saying that they should not have cut rates, and other FOMC members saying that they should have cut rates more. That tells us that there was already a significant amount of disagreement on the FOMC when you have dissents that are literally pointing in opposite directions. My view is that I am still worried about inflation being sticky and too high. Inflation today is 3%. The consensus expects inflation for the next 18 months to be 3%. So it is still the case that we're just not quite back to the Federal Reserve's 2% target. So with that backdrop, it is a risky strategy to continue to cut interest rates, because particularly when we look into next year, where there's some tailwinds building, that the trade war is now further behind us. We have some new tailwinds coming because of the one big beautiful bill lifting GDP growth. The dollar has been going down. That's lifting exports. We also have had oil prices have been drifting lower, which also helps consumer spending. So with that backdrop, the risks are growing that we might see some acceleration in 2026, and therefore cutting interest rates just before the economy begins to accelerate was, in my view, not the right decision. And I know I've been reading your writings from your newsletter, which was Dear Santa and What I Want for Christmas, and I loved it. It was absolutely fantastic. So let me ask you this version of the same question, namely, what do you think and what do you want for 2026? What do you think we should be expecting from the Federal Reserve? Because my view would be that they should not have cut rates, and I think that they should be proceeding more carefully. Is that also your view, or do you think that there's more room for cuts as markets have been pricing?
Torsten, I was fine with their decision to cut one last time in December. I think they've gotten to what most of us would agree is a neutral rate, or very close to it. But I share your concern about a reacceleration in inflation in 2026, which is really a very out of consensus view. I read all the street research, and there is almost no one calling for a reacceleration of inflation. And when I looked at the Fed's summary of economic projections for next year, I would describe this as almost a nirvana forecast. They raised the growth rate from 25 to 26 from 1.7 to 2.3. They left the unemployment rate basically unchanged, actually took it down from 4.5 to 4.4. And then they took the core PCE inflation forecast from 3 to 2.5. So we're going to get faster growth, very robust employment, and a fall in inflation. I just think that's overly optimistic. I don't actually think that will happen. And I think there's more risk to the upside on their inflation forecast, certainly than they think. And I believe that for the same reasons that you do, the ones that you just mentioned, the stimulus, the monetary stimulus, the fiscal stimulus, the OB3 stimulus, and also a lot of rate cutting around the world that's going on for this entire cycle. So I also think about some of the structural tailwinds, demographics, a housing shortage in the United States, a 3-year highs in industrial commodities. I could go on, but I think there's some structural tailwinds now that to inflation that did not exist before the pandemic that will be with us for a long time to come. And set up against that is the great specter of AI, which may be the most deflationary force we've ever seen. So inflation's always a tough call, but I think the risk is to the upside in 2026.
Well, then we have to see exactly to your point. I agree that AI has the potential to lower inflation, but at this point, it is still a little bit early. I hope you agree with this to come to the conclusion that AI will have a dramatic downward pull on inflation. We haven't quite seen the dramatic increase in revenue in a lot of the companies that are selling large language models. So in my view, the S&P 7, the Magnificent 7, has been doing really well. But what we're, of course, watching out for and what could be very exciting in 2026, if that spills over, so that next year the S&P 493 begins to do well. In other words, will we see the adoption of AI begin to spill over to the remaining 493 companies? Or are we still just seeing most of the gains in the Magnificent 7? That becomes a key topic when we look into next year.
I want to touch on one thing before I get into that. I think in the near term, AI could actually be a pro-inflationary force because we've got so much CapEx going on and we've got so much capacity we're going to have to build that it's a strain on production. It's a strain on certain parts of employment and materials. So in the near term, in 2026, the AI boom could actually be inflationary. Now, in terms of the broadening of the markets, I will admit that I expected more of this in 2025, and we really didn't get it. Small and mid-cap companies have been very disappointing as indices. They have underperformed the large cap indices. Where we did maybe get it a little bit more was in international and EM doing much better than the S&P 500. But I'm going to hang out there again with this view in 2026 that small and mid caps will do better. There will be some broadening in the earnings away from just the very large cap U.S. technology companies. And I just think that as AI becomes more pervasive in the workplace, there are more companies that will benefit. It will not just be technology companies that benefit from this. It will be companies in the everyday world squeezing more productivity out of AI, and we'll get better and better at it. We'll never be worse at getting productivity out of AI than we are today. We'll just keep getting better.
I completely agree. I also think that we will begin to see the benefits begin to show up next year, and combined with the tailwinds we spoke about earlier, namely the dollar going down, energy prices slightly lower, and the one big beautiful bill. I still think that going back to your very first question, that the Fed cutting interest rates is a little bit of a risky strategy because exactly as you're saying, I completely agree that in the near term, remember that the data center build out and the associated energy build out is very, very strong at the moment. And at the same time, the wealth effect for consumers who are benefiting from high stock prices is also very strong. So both on the consumer side, which is 70% of GDP, there's support from high stock prices and high wealth effects. And you have likewise on the CapEx, meaning business spending side, which is 15% of GDP, you also have strong support to growth. So in the near term, I still think that growth could begin to accelerate and look better. And exactly to your point, we might begin to see that growth acceleration also begin to put some upward lift on inflation. I hear you, and I agree that this is out of consensus. But our jobs, of course, as investors is to try to figure out what are the things that are not priced into markets, what are the themes in markets that we should be taking into account when we design portfolios and do asset allocation.
Yeah, so the Fed path will be very interesting for next year. We know we're going to get a new chairman in May, And I think it's pretty safe to say that this new chairman will be aligned with the administration in terms of wanting lower interest rates almost at any cost. I'm dumbfounded by this because to me it seems like the administration's biggest problem is inflation, not growth, but yet they're focused on growth and not inflation. So it's going to be very interesting. The mix of the board members is going to be very interesting. And I've said for a while now that the institution itself is fiercely independent and it wants to remain independent. But the easiest way to remain independent is to kind of shade toward easing at, when in doubt, ease, because it takes the pressure. It's an easy release valve for the institution to remain independent, at least in the near term.
I agree. And as exactly you're saying, that when Jay Powell steps down on the 15th of May, it becomes very interesting, partly when we will find out who the next Fed chair is. There's a number of different names. Kevin Hassett, Kevin Walsh, could also even perhaps be Scott Bessent. But those names, it could be quite important who of these different names it is, or if it's some other name, because that will, of course, be driving the organization so importantly, because that person has to do now the FOMC press conference, and we know how important that is and how much markets listen to that. So that's why from a Fed perspective, I would expect that at least into the next several meetings, the FOMC is going to stay on hold and going to take it easy and say, we will not cut rates. And maybe Jay Powell will say, I'll leave that to the next Fed chair. Then he or she can come in and do what they want to do. So we're entering a little bit of a vacuum here before we find out who it is and therefore what that person ultimately wants to do. It is ultimately, of course, a committee decision whether interest rates should be cut. And there are 12 voting members. There's 7 governors and 5 regional Fed presidents. So the president himself, in this case, Jay Powell, cannot decide. He's just one vote out of 12. But it becomes very important to then begin to understand and listen to speeches. What is the Fed chair saying? And are other people coming along to his or her view in terms of what the outlook should be for rates?
And Torsten, just for our listeners, is it a majority vote by the Fed, or does the chairman actually have a super vote?
No, it is a majority vote. And this is an extremely important question because the Fed votes on a number of different things, but the most important thing, of course, they vote on is whether interest rates should go up or down. So the new Fed chair can come in and say, I would like to lower interest rates, but if the 11 other FOMC members say, we don't want to lower interest rates, then interest rates are not going to go down. And importantly, likewise, it is also an FOMC vote decision if they should do asset purchases, meaning QE. So in other words, it is also not the case that the new Fed chair can come in and decide to say, I'm going to buy a lot of 10-year government bonds. That person cannot even say, I'm going to buy a lot more T-bills. So the Fed did decide at the last meeting to buy 40 billion in T-bills now to help some of the problems in the money markets. But the short answer to your question is all decisions on the FOMC are made by majority. And that's why the new Fed chair needs to persuade the other FOMC members what he or she wants to do. And this is where the challenges come in, namely whether that's easy or difficult, or whether the Fed chair that comes in is actually going to do that or not.
Yeah, it's going to be such a fascinating year ahead. And we talked about the inflation side of the mandate, but let's touch for a moment on the labor market side of the mandate. Are you concerned very much about the state of the U.S. labor market, or do you see it steady as she goes?
Yeah, this is very, very important because if we go back and look at what job growth was in the fourth quarter of 2024 last year, job growth there was about 200,000 jobs were created every single month on average. That has been declining steadily. Now we're down to roughly around 50,000 jobs created. Why has job growth declined? Well, you could conclude that, that's because there's less labor demand. But what is extremely important is to also recognize that it is also because there's less labor supply. Since 2024, 23, and 22, we had immigration at an annual rate, net immigration into the U.S. of around 3 million people. The Congressional Budget Office is now forecasting that for the next 3 years, we will have net immigration dropping from 3 million people per year to 500,000 per year. That's a very dramatic decline in the number of people coming into the workforce. So as a result of that, the Dallas Fed, around the corner from where you sit, have actually forecasted that we now should expect to see that the equilibrium rate for non-farm payrolls is now 30,000 jobs every single month. You and I cannot remember, and you and I have talked about this before, for decades. We've been used to the job growth should be around 100 to 150 and sometimes 200,000. And now suddenly the Dallas Fed and other Federal Reserve banks have come out and said, because of the decline in immigration, being so strong, partly because of illegal immigration slowing down, but also because of the $100,000 fee on H-1Bs. Because of that, we should expect to see job growth slow down. So this has opened up a very important debate about why has job growth slowed in the data over the last 6 months. Is it simply because there are fewer immigrants coming in, or is it actually because the economy is in a bad shape? And the Fed has clearly voted with a view that the economy is not in a good shape. But I think that they are misdiagnosing that there is actually a very strong argument, which, by the way, comes from their own Fed researchers, again at the Dallas Fed, which tells you that a lot of the decline in the labor force is indeed, and therefore in job growth, because of lower immigration. So that's why the labor market is actually still okay. It's not as great as it was, of course, just after COVID, where everything was booming. We have seen the number of jobs come down. But the bottom line to your question here is that the labor market is actually still in reasonably good shape. And that's why I think the Fed still has room to go ahead and keep interest rates on hold for the next several meetings.
Right. Good answer. And I have no difference in view with you on that. Your firm, Apollo, has done such a good job of helping us market participants understand the current state of credit markets, both public and private. And I wanted to ask you what your outlook is for U.S. credit markets next year. And are returns set to decline somewhat with easier money from the Fed and more competition from banks? Or are we still in an enlightened stage of very positive markets for both public and private credit?
So I think that the outlook for credit is still positive. I don't know if I can share my screen, but let me see if I can do this here together with you and show you just a few charts that exactly discuss this very important topic. There's been a lot of conversations more recently about single names in credit that have had challenges, Tricolor, First Brands, other events where the market has begun to discuss, is this the beginning of a credit cycle, or is this just an idiosyncratic episode? And looking at this chart here shows you the default rate for loans in the green line and for high yield in the blue line. And if those events we've seen in credit markets more recently were the beginning of a credit cycle, default rates would be going up, but default rates are actually going down. So one way of answering your question is that at least looking at where we are in the credit cycle, it looks like the credit cycle is getting better. A different way of looking at this is to include distressed exchanges. Distressed exchanges is situations where companies, in popular language, kick the can down the road and they delay their interest payments for a number of different reasons. And you see in the orange line here that in the last 12 months, LTM means the last 12 months, what is the number of defaults plus distressed exchanges? And that has also been declining. So the short answer to your question is, when I look at default rates for high yield and loans, that's coming down. And when I look at also, in this case, default rates and distressed exchanges also coming down, that tells me that we should expect to see a credit cycle getting better as we get into 2026. So the short answer to your question is that I think that credit markets are going to continue to do well as we enter next year.
I can't really recall more hysteria around an asset class than we had in the fall of 2025 surrounding all things credit. Tricolor and First Brands and New Horizons and a couple of those broadband companies in Europe absolutely panicked investors about this asset class and pushed down a lot of equities associated with credit. But the performance has been pretty good this year. And I think your view, once again, is very out of consensus, but is probably right.
Well, and I think also to what we talked about earlier, if inflation is going to stay elevated, and again, the consensus expects inflation to be 3% for the next 18 months, then yield levels from the Fed funds rate is going to stay elevated. And in the long end, we've seen a steeper curve because not only is there, of course, some risk that inflation is going to stay higher, but we also have some fiscal challenges that are also making the yield curve steeper. That also means that yield levels further up the curve are also going to be more elevated. This means that cutting coupons in fixed income is going to continue to give you a very nice cash flow. You will get a very nice cash flow if you in particular go up in quality and credit, ideally investment grade credit, where you, of course, can select higher credits, be first lien, senior secured, top of the capital structure, investment grade, that generally, of course, does well through the business cycle, then you will be protected and you will still be benefiting from the yield level being higher. So I still think that cutting coupons in an environment where interest rates and yields are higher continues to be a solid strategy. So let me ask you also, of course, from a credit versus equity perspective, one issue that comes back to what we spoke a little about before is that you and I have talked a lot about how AI and the Magnificent Seven have become so big in the S&P 500 index. Now the 10 biggest stocks, they make up 40% of the basket. That's a very significant share. But now we're also beginning to see the hyperscalers and the AI companies issue more credit in the public market. That means that the public IG index is also becoming more reliant on AI. So from a portfolio construction perspective, how have you thought about this, and how do you think about whether you and I agree or disagree on what we think will happen to AI going forward? But it's just very clear that no matter how we design asset allocation and portfolios, we're now basically becoming more and more vulnerable across the board to the AI story, and the AI story continuing.
Yes, that's an observation that I had not really considered. We have done, as a firm at Capitol Creek, we've done very little with public credit. We just haven't seen a lot of value in public credit, and we prefer to be in private credit, where we can exchange liquidity for higher yield, tighter documents, less risk, and just better spreads, quite frankly. And so that's where we've been doing our work with you and other firms. And when I think about credit relative to equity, I think back to what I learned back in the late 1980s from Michael Milken, when he said that if you can earn equity-like returns in credit, and I think you can quite easily without that much risk, earn 8 to 10% returns in various forms of private credit, especially by taking a fraction of the risk that you're taking in equities. In the S&P 500 today, we have very high valuations, we have very high concentration risk, and we have a great unknown in terms of the capital spending boom in artificial intelligence. So there's a lot of risk concentrated in the S&P 500. If I can get that 8% in private credit with a fraction, with I'd say probably a third of the risk, and over the long sweep of history, you're trying to make an 8% total return in equities, I really like that trade-off. So I'm going to stick with the credit asset class. I agree with you. And when I think about the Fed's forecast, and I don't necessarily agree with what I described as a nirvana forecast, to me, that was more of just what they hope will happen rather than a forecast. But if somehow they are right and growth accelerates significantly next year and inflation falls and employment remains robust, that's a fantastic backdrop for credit. So I think it's too early to abandon the asset class. I think that there was way too much hysteria that was frankly very uninformed. A lot of the fear was uninformed. It's amazing how little people truly understand credit, and how the lack of understanding of private credit, as if it's some kind of hidden nefarious asset class. It's absolutely enormous, and it's been going on since the dawn of time. But yet, I guess it's cloaked in mystery for a lot of people. You guys have done a great job of demystifying it.
I couldn't agree more. I could ask you for $100 to go and build a coffee bar here in Manhattan, and that would be private credit. You give me a loan, I go and start building, or I ask you for some amount for some other thing that I'm going to do. That is private credit. It's been around since mankind began. So you're absolutely right. It is quite surprising. So that's why I think that the main, in my view, conclusion based on everything that has been happening in the last several months is that it is all about underwriting standards. Public credit, private credit, what really is the critical issue is how risky is your underwriting standard. Are you taking a lot of risk, meaning is it high yield, or are you taking less risk, meaning it's investment grade? So that's why, just like in public markets, you can buy investment grade that has very little risk or less risk, or you could buy high yield, which has more risk. And likewise, in private markets, I can get investment grade, which has less risk. I can also get high yield, which has more risk. So it's the same everywhere, namely it's all about the underwriting standards. And that's exactly what investors need to take into account, namely how much risk is the different managers that I'm looking at taking. And what's of course important, as you know very well, is that here at Apollo, we are to the largest extent all investment grade And that's, of course, very important because that means that we feel strongly that we are sufficiently protected against the downside risk that might come along if there is a slowdown coming. Yes, there are other that have views that they should take investments in, say, software, enterprise software, life sciences, businesses where there's very little cash flow here and now. But if interest rates are higher for longer, then the net present value of future cash flows that are distant into the future, of course, become much more vulnerable to what the discount rate does today. So the short answer to your question is that I agree that private credit has been misunderstood by some market participants here, especially in the last few months. And I think it's important to just keep in mind, it's all about the underwriting standards. How much risk are we taking? And are we taking a lot of risk? Are we taking not much risk?
And for us, as allocators, it's what I came to the conclusion a while back that it's all about who we choose to do business with. And one of the reasons that we do business with Apollo is because we have a lot of confidence that you guys originate your own loans, you eat your own cooking through Athene and your other funds. And we know that the ethos of the firm is to have very high underwriting standards. As Mark Rowan says, to get a proper return on risk taken. I didn't state that exactly right. I forget exactly his quote, but I know that comes from the top down from Mark and pervades the entire organization. So we're comfortable with you and our other partners underwriting private credit.
So just to be clear, we have more than $900 billion under management at Apollo, and a significant part of that is Athene's balance sheet, and Athene, our insurance company, and Athene's balance sheet, 97% of the Athene balance sheet is investment grade. So that means that we are, from a regulatory perspective, from an investing perspective, we are having very, very high and tight and strict underwriting standards with the tight, restrictive covenants in place. We have downside protection. We essentially do exactly as you're saying, eat our own cooking.
Well, Torsten, why don't we segue away from credit to something you mentioned earlier, which is the U.S. dollar. So I thought one of the most interesting things about 2025 is that the dollar had one of its worst years in a long, long time, down 8 to 9% year to date as we're coming toward the end of 2025. And I'm wondering, was that just the first leg down in what is going to be a significant cyclical bear market for the dollar that may have run only part way, and that 2026 will be a continuation year of the dollar bear market, or do you see it differently?
What's so remarkable about this year is that when you and I spoke, I think was it in the summer last time, if we really begin to think about what we've been through this year with the trade war and Liberation Day, I would have predicted, wow, this is going to create a fairly sharp slowdown. This is a problem for the economy. This economy is not going to handle very well a lot of the uncertainty that came up with the trade war and also, of course, the rise in tariffs. But given where we are today, the economy is actually still doing reasonably fine. So the resilience of the economy has been actually quite remarkable. So with that backdrop and looking into next year with some acceleration in mind, I actually think that the dollar could actually do better next year. Foreigners in particular, they did sell US assets in April when Liberation Day happened. They were selling treasuries, they were selling equities, they were buying credit, but they were also selling agency bonds. But since April, for the following months, foreigners came back big time to buy US assets. So I'm skeptical of this idea that the rest of the world doesn't want to buy US assets. I think the rest of the world is coming to the US for two reasons. The rest of the world comes to the US to buy AI, and the rest of the world comes for the second reason, to get yield. There are levels of yields in credit, in rates, in private credit that you cannot get in Europe, you cannot get in Japan, you cannot get in Canada, Australia, or elsewhere. So for that reason, I still see in the flow data a lot of money coming into the US, and that is supporting the US dollar as we look into 2026. So with the AI tailwind likely still continuing, if that turns around, of course, then we have a different discussion. But with yields higher for longer because inflation is higher for longer, I do think that both forces that have been lifting the dollar, namely the AI story, and at the same time, yield levels higher for longer, I still think the dollar has some good tailwinds from a cyclical perspective over the coming quarters. So let me ask you, are you more worried when I have then talked about the business cycle impact on the dollar going up? Are you more worried about issues around the new Fed chair or the fiscal situation, or what makes you think about what the outlook for the dollar? What could be the downside risks for why the dollar could be going lower in your view?
Yeah, Torsten, I wrote a piece last year in February entitled "A Deep Dive on the Dollar," and it was a very bearish piece. And it was just lucky that it was timed a little bit before Liberation Day and the big Sell America theme. I think that we're in a bear market for the dollar. Uh, I think we've had an interlude for about the last 4 to 6 months where we've really just gone sideways. And maybe here in the last couple of weeks, we've started to go back down again. But I think that the world got overexposed to U.S. assets over a 15-year period. I think that international equities and EM equities will probably outperform the S&P 500 again this year. I think that's a durable trend for a whole host of reasons we don't have time to get into. But I think there will be more desire to get more diversification away from U.S. equities. We know they're the most expensive and most concentrated, so I think it just makes sense to edge away from that at the margin. I think we'll continue to run very large trade and budget deficits, which is a secular headwind for the dollar. And I do believe that the administration wants a weaker dollar because the administration has always been very focused on trade, and it's the easiest way to make significant headway in reducing trade deficits. I don't necessarily share their fixation on trade, but I think that's going to be a persistent theme for them. So I think they want the dollar lower. I think the new Fed chairman will potentially join hands with the Treasury Secretary and talk the dollar lower if it doesn't go lower of its own volition. So, yes, I think before it's over, we'll have a real cycle and we'll have a 20-25% decline in the U.S. dollar. So I think we're in what I'd call the third and fourth inning of that down cycle for the dollar.
It's also very clear that a lot of hedging has taken place earlier this year among foreign investors. So as foreign investors hedge, that also puts additional downward pressure on the dollar. So you're right.
Expensive currency, a very expensive currency on traditional measures. And the yield spread is also compressing. Every time the Fed cuts rates, that yield spread compresses a little bit more, and there's less carry to entice you to hold the dollar. So I'm going to be patient with my bearish dollar theme. I think it's probably still game on for next year, and I think that's a tailwind for the commodity story. Commodities like copper and silver and gold and platinum and perhaps even some of the softer commodities and even agricultural commodities if weather cooperates. And so energy is another story. I think there's just too much of it. It's structurally oversupplied. But if you look at the CRB RIND index, the RIND, the Raw Industrial Materials Index, or if you look at the Bloomberg Commodity Index X Energy, you're hitting 3-year highs on both of those. And I think that's a production story. I think it's a decent economy story. I think it's an earnings story. Earnings tend to correlate pretty well with raw industrial commodities. So, I think that's another wrinkle in this. And it's also a potential catalyst for our upside surprise to inflation next year for both of us.
Exactly. I was about to say that. I know we're getting up against the end here, but it's a very important point to square our circle back to what we talked about in the beginning. Remember, as we all know, when the dollar goes down, things that we buy abroad become more expensive. So that means that import prices, and therefore inflation goes up when the dollar goes down. And if we already have inflation at 3%, and let's say the dollar were to go down 10, 20, or 30%, that would certainly be a very positive impulse, meaning lifting U.S. inflation much more than what the Fed would like to see.
Well, Torsten, I want to just give you one last question. I noticed in the Daily Spark, it might have been last week, that that a reasonable forecast based on where we are today in terms of valuations for the S&P 500 would be a very low return over the next 5 years, maybe even a flat to even negative return. Is that your central case? And walk us through that a little bit.
Yeah, so I know this was slightly controversial because this is just so let me actually pull this chart up here. This is just a very, very simple picture, namely here. I'm showing you on the y-axis, we have the 10-year subsequent annualized return, and on the x-axis we had the forward PE ratio. So today the forward PE ratio is just between 22 and 23 for the S&P 500. So if you go back in history and look at when the forward PE ratio for the S&P is around 22, what does that mean for returns over the next 10 years on average? And the answer is, it means that returns on average for the next 10 years will be, are we sitting down? 0. So that means that, in other words, valuations are so high. So the main insight from this chart is really not particularly innovative as such, but it really reminds us very importantly, if I put money to work in an asset that is very, very, very expensive from a PE ratio perspective, then it raises the bar to earnings and therefore to returns going forward. Whereas if I put money to work in an asset that has a low PE ratio, of course, then it becomes more possible to make a decent return over the coming years. And the challenge is today that we have now the S&P at such a high elevated level that, at least using that historical scatter plot that I just showed you there, it does point in a direction purely on that statistical relationship. There's a lot of other things, of course, that are going on, but that we should be cautious about the outlook for the S&P 500 simply because valuations are as elevated as they are at the moment, which is, of course, mainly driven by the Magnificent Seven being valued at extremely high levels.
Yeah, I think it's a great warning. I liked that regression a lot as a reminder. And I think it's one of the reasons why we want to encourage our clients to look elsewhere, look to the developed international markets, the emerging markets, and small and mid cap as ways to get your equity exposure away from the S&P 500 that's done so well for so long. And well, I guess we've pretty much exhausted our time, but I want to thank you again, my friend. It's always great to engage with you and share our views. And I want to thank our audience for tuning in. And I'd like to wish you and everyone in our audience a healthy, happy holiday season and much prosperity in 2026. Thank you.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.